What happens to that person when they start reading climate science literature in 2001? Here I am. So ended up getting a master's degree in science and some other degrees, and I've worked at the intersection of climate change, sustainability, and ESG as a technical expert for about 15, 20 years. So we're going to rapidly go through some scientific analysis for you. This is all peer-reviewed, and then we're going to go talk about some risks to the economy, and I'll hand off to my distinguished guests. And thank you. Yes, I live in Austria, so it's nice to be. I live in Austria, so it's really nice to be here. So, how do I do this? There we go. The state of the climate in 6 charts. We've already discussed some of this, but I want to go through some of the details of the data, in particular how data is collected, so you never ever have to ask about the rigor of the data. Right? So the parallel what we see in the markets are, does anybody know what Microsoft share price was yesterday at 12:31 and 30 seconds? I bet you do, right? I teach, so I'm gonna call you up. Great idea. I have no idea. That's when someone says, oh, that's weather. It was one single data point. But you could probably tell me the long-term trend over the last 30 years of Microsoft, right? It's sort of gone up and come down, it's gone up again, right? So that's millions and millions of points of data that went into that. That's the distinction between climate and weather. Climate is calculated generally over a 30-year time frame. The quantity of data that goes into the calculation of climate trends is conservatively in the hundreds of millions of data points. So how many points of data did the U.S. government measure last year in climate change? Millions and millions and millions of data points, right? There's about 32,000 different measuring sites in the U.S. alone. I mean, the U.S. government has, plus the satellites, and they're measuring either constantly or continuously or not continuously, but discretely each day. It's millions of data points, and then aggregated into using supercomputers and algorithms to come up with calculations. So when we see in the top left, okay, you see in the top left, that's the 5 large global data repositories of climate data in the world for the last 150 years. That's why you see it's mimicked. They mimic each other. The parallel to that from the capital markets perspective is like what's happened to the capital markets and pricing the last 150 years. Look at all the world's exchanges. Out of that quantity of data, that's what you see there. It's rather ubiquitous. I mean, it's simple. You can see the curves. I can go through a couple more data points on that. As we know, surface temperatures in 2020 were about 1.2 degrees Celsius above pre-industrial levels. Pre-industrial levels is basically 1850 or before, right? Depending on the data set. It's like I said, it's 5 key data sets, and there's millions of data points they capture on an annual basis to calculate what you see up here. Okay. Now, that's not just where we're seeing climate change occur. We're seeing in the atmosphere too, right? We're also the satellites since 1970s, and this is going to be the next one over. Satellites have been able to measure the increase in temperature of our atmosphere through the atmospheric stack. And again, that's millions of data points by different types of satellites, by different governments around the world. Again, think of the parallel. What's happened to capital markets for the last 150 years? All of our work as CFAs or economists, we look at millions of data points and come up with assumptions. That's a distinction. Whether Microsoft, what was the price at 12:31 and 30 seconds yesterday? Who knows? I don't care. Unless I sort of care, but not that much. Right? Arctic sea ice. Again, millions of points of data. As you can see here, and that's going to be the bottom left. We have the ability to go back using ice cores, almost 2,000 years in the Arctic sea ice, and it's not looking good. Well, you may see, now why does that matter from a climate perspective? And somebody was talking about Texas. We had the climatic event in Texas 2 years ago, I think it was. That was because of the Arctic sea ice. How? The ice is white. It reflects energy. You have less ice, you have dark blue. Who wants to have a black car in Florida? You're going to cook inside because it absorbs energy, right? This is the nature of the chemistry of how electrical photons work. And so what happens is when you remove that white covering of the Arctic, and it becomes blue, it absorbs energy. When you absorb energy, it heats up. What that does is that impacts our the jet stream. The jet stream is the sort of the atmospheric energy that goes. It's actually winds, but it's the moving of the atmospheric energy between the upper latitudes and mid latitudes. When you fly in a plane, and that's why it's quicker to go from here to Europe than from Europe to here, because you fly in the jet stream, because it goes west to east. Well, that jet stream is supposed to be stable. It's stable because you have what is called Arctic oscillation. Arctic oscillation is the low pressure of the high Arctic, because it's supposed to be white Arctic snow and white ice that reflects energy, and versus the high pressure band that surrounds Arctic. Well, when you have blue water that's absorbing energy, the high pressure becomes a little bit warmer, and it's a matter. It's not that much. We wouldn't feel it. But the distinction is that then makes that high pressure band, which is what we see in the Gulf Stream, much weaker. So you see the Gulf Stream coming down to Texas, bringing, guess what? Cold Arctic air down to Texas. That is an example of climate change. So we see that dense in the Arctic. Glaciers. Now here, it's going to be up here on the screen. You have 164 different glaciers that are measured in 19 countries around the world, and almost all of them are receding. I think one person mentioned their colleague was in Greenland. I was recently, a couple of years ago, on top of glaciers at 6,000 meters in Ecuador with a big sign about protecting the planet, because those glaciers are rapidly declining. In fact, in our lifetime, there's forecast there'll probably be no more glaciers in the Arctic. The chemistry of the atmosphere is making that impossible because of how much the atmosphere itself is heating and how much land-based temperature is heating. So glacier melt is increasing. Now the problem is, think about it from a finance perspective. That means if glacier melt and snowpack are heating too quickly, that bank, just like a bank, you're pulling money out of that as the water goes down the hill, right? Goes down the Ganges, or you don't have a snowpack storage or bank account that you would have in California. So that may not be a problem in February, but in July, when you have no more money, you have no more snow, you have no more water. And that's exactly what's happening to the central coast of agriculture industry. There's just no water because that snowpack is melting too quickly because of climate change. And also the glaciers are melting, and so you don't have that residual bank of water to power that local economy. That's around the world. Sea level rise. Well, heard about that. We saw the impacts recently, and unfortunately in Florida. It's been 6 to 10 inches in the last 100 years, 120 years. In fact, there used to be a sea level monitoring station in Louisiana, and it sunk. It's no longer there anymore. It's because sea level rise depends where you are, and there it was 3 feet. That's why part of the reason why Louisiana as a state has lost 1,900 square miles of land in the last 150 years. It's sea level rise and soil subsidence in canals. So we are impacting, climate change is impacting our economy, whether we like it or not. So finally, the worst circumstance is what's happening to our oceans. Global heat days, as measured as the amount of heat that you can measure down to 2,000 meters of below sea level in the oceans, actually is increasing rapidly, and it's where we see the greatest climate change impacts. But how many of us live on the sea? No one. I had the good fortune early in my career, before moving to capital markets, working oceanographic research. I've been in the ocean, but that's a different offline story. None of us have, and that's where we're seeing incredible impacts. Because 93% of our greenhouse gas emissions, the energy embedded in greenhouse gas emissions, is being captured. The excess emissions is being captured by the oceans themselves. So that's why you see the heat map. The average heat trapped by oceans increasing significantly, and it's measured down to 2,000 meters. And you see that ultimately in currents. So now the current of the Gulf Stream, which is that powerful current from Florida, comes up along the coast, goes all the way, up here and goes into Europe. And that's why Europe, you have temperate weather. That's why I live in Austria. I get temperate weather. It's ultimately because, as I said, it's a temperate climate with weather on top of that. Sorry, and that's driven by the Gulf Stream. The Gulf Stream brings that enormous, slightly warmer water up into Europe. Well, that's actually slowing down now. When that happens, it's not going to be a matter of, let's change rates here, let's change rates there. It's going to be like, well, are we going to have an economy in a dead planet? And when I give this lecture, people are often don't want me to come back because they're too scared. So I'll try to be no kinder today. So this is where we're at. Last year, no place in the world had average cold temperatures below average across the year. There were moments of cold temperatures around the world, but there was no place in the world had average for all 365 days below normal cold weather. 87% of the Earth that was measured had above average warm temperatures last year. That's it, ground level. So where we're at, as our colleagues have discussed here, we're sort of today, we're supposed to do a transition to a low carbon economy at 1.5 degrees Celsius. I would like that to happen. I don't think that's going to happen. I think, but that's not me as an individual. That's sort of what I'm forecasting. I think you just need to know that there are transition pathways here. And these transition pathways, and you see an image like this in the Intergovernmental Panel on Climate Change, these are models you can run yourself if you want to, but they're also very complicated models when they forecast out what's going to happen to 2050, because this is called the shared socioeconomic pathway. The basis of this is the intersection of climate data and what we can do as economists and as investors in the private sector to change, and in the public sector to change and to influence policy and capital flows. So in the best case scenario, if we do absolutely everything we possibly could, we're maybe looking at 1.5 degrees Celsius, but that'd be very surprised. Now, what does that mean? Right now, the embedded emissions we have already in the atmosphere, because emissions live in the atmosphere more than a single day. Some of the emissions will be in the atmosphere thousands of years. Means that we will see, not maybe in our lifetimes, assuming our children and grandchildren's lifetime, sea level rise of up to 10 feet in some parts of the world. That means Florida basically is uninsurable within the next 30 years. We are right here in the very bottom left. And you can see this is the increasing temperature as a measure of risk going out to 2100. And if we're at sort of a little bit of red and blue, it's just going to get significantly worse, even if we stop emitting a single ton of carbon right now, or a single ton of nitrous oxide, or a single ton of methane right now, because the embedded systems store those emissions in the atmosphere for a very long period of time. Now, when we're talking about nitrous oxide, methane, or carbon dioxide, has anyone heard of parts per million? And including my panelists. Yes. So literally, you're talking about the distinction of carbon dioxide. It goes like from 375 to 376 parts per million. It's one marble that changes color out of a million. One marble that carbon dioxide out of all the parts per million in the atmosphere that changes color is what is changed that creates that change. When it's methane or nitrous oxide, it's parts per billion. The atmosphere is that fragile. So capital markets are taking action. There's lots of different initiatives out there. What you want to know right now is this is what the task force, the climate financial risk disclosure model. You need to be aware that you have physical risks on the bottom left, which are both acute and chronic. These are risks you can experience. Right, chronic are happening consistently. Sea level rise along the Texas, Louisiana coast. That's going to happen for the rest of our lives. The only way it would stop is if we change the laws of physics. I'd love that, but it's not going to happen. We see acute risks happening. That's like increasing storms. Right? Because sea level rise happens consistently. The storm is inconsistent. We don't know when it's going to happen, so it's acute. Then you have transition risks you can read in the screen. And my computer just shut off. 1 second. So to give you a short story, this is all abstract, but what does it mean to the markets, right? In 2019, I modeled out with a colleague of mine the natural capital dependent exports for the G20. Just using some trade data, a little bit more than just some trade data. It was a lot of fun. And what we found was that in the G20, you could rank the countries globally by which of the countries in G20 were most dependent on natural capital exports Natural capital being something you can grow. You can harvest, like think of soy or corn or cattle or poultry. And guess what? We found that Argentina was 60% of their total exports were natural capital dependent. Went to Argentina, started talking to soy traders in Rosario, which is a town about 4 hours northwest of Buenos Aires. And they're like, Gabriel, did you know that last year we did not produce soy? We had to import soy for the first time from Minnesota, where I'm originally from, and South Dakota, North Dakota, all the way down the river, all the way around down or through the Atlantic, all the way up the river in Paraná River in Brazil, Argentina, to our refineries to process that soy to then export it back to Europe. So they had a significant decline in soy production and exports in Argentina in 2018 because of climate change. They have what you call relámpagos. Don't worry about the word. 70,000-foot storms that collide and create, think of superstorms, right? And that's where you get at times hail of up to five feet in 15 minutes. That would destroy the soy crop. And so the soy crop was destroyed. No one may care. That may not be my field of expertise. I'm not a natural capital scientist. I'm not interested in sustainable systems. Understood. Except Macri's government in Argentina, the export tax on whether it was processed or raw soy products was between 24% and 29% in dollars. So how much money did they lose? Too much, yes, too much. Up to $2 billion in what they lost that would have gone to the central bank. And then what happens? Bankruptcy or default. And so Macri could not pay the social services he had promised to the community members. But couldn't fund schools, couldn't fund teachers, couldn't fund healthcare, couldn't pay for roads because of the soy crop that was destroyed because of the climate change. And because of that, they went into bankrupt. They went into default and bankruptcy. And when that happens, you get a changing government. You can look at sovereign health of the G20 from a natural capital lens and start calculating your risk in the work you do on a daily basis. And how much more time? 2 minutes. So that's an application of the TCFD model. I will go through one more just set of definitions. I want to end early, pass it to my colleagues. You just need to understand that climate risk is a financial related risk. Climate risk has 2 categories, and as you can see, physical and transition risk. You can calculate climate risk. No, this is not, I don't use an equal sign here because it's not an exact calculation. You can get an idea on climate risk, from climate risk to hazards to exposure and vulnerability. And then from this, pardon me, I'll go back up one slide and I'll finish because these are not completely. That then you can model out how climate risk impacts income statements, statement of cash flows, and balance sheets. And ultimately, you can then look at liquidity ratios, performance ratios, and other financial ratios. And that's the type of work that I've worked on previously and do currently. And you can look at companies like Noble Group that then go into default because they have not captured financial risk and climate change in their accurate financial statements. So thank you very much. I'm going to end a little early.
Next, we have Mark from the local community. You're very happy.
Yes, thank you for having me. Thanks, Stuart, and thanks all of you for being here. So I'm going to dive right in. I think we've heard a lot this morning about the increasing urgency in the science around climate change. Certainly, we heard from Stuart earlier around how governments are falling short on their commitments. I'm going to talk about how the capital markets can help. I'm going to first lay out where we are in terms of how the capital markets are helping to close that gap. I do have some good news that a lot of the historic barriers that have prevented capital markets investors from taking action, they're starting to come down. Then I'm going to finish with a couple of case studies and ideas around how we as investors can build climate-aware portfolios using a variety of approaches, stemming from divestment to leaning into solutions like green energy, but also this idea of engaging with some bad actors, which I do want to address the energy independence issue you had on we heard about earlier. So again, I'll dive right in here, and I mentioned the capital gap, and it doesn't start with good news, so I apologize on that. So we heard about this 1.5 degree Celsius temperature rise. I think all of us are aware that above that is where you see the worst effects of climate change on mortality and the economy. So from a capital investment standpoint, this is in 2021 data from the Policy Carbon Initiative. We had about 632 billion of investment. It's a good number. It was actually a record number. It was a significant increase from what we saw in 2020 and 2019. It's been a nice, straight line up. The problem, of course, as you look at the page, is that it is nowhere near enough. We need $4.13 trillion through 2050 to bring us to that 1.5 degree Celsius temperature rise. Certainly governments can help. We heard about that earlier. Certainly private investments can help. We heard a little bit about that from Sean as well, but what about the public capital markets? This is $70 trillion in terms of assets that the public capital markets control. What about them? How can they help address this gap? So I do have some good news. Like I said, if you were to try to do this, let's say 10 years ago, you said, you know what, I want to take my public market portfolio and I really want to ensure that it's addressing climate-related risks and opportunities. It would have been really hard for you to do it. There's been three key barriers that have really held back a lot of institutional investors and others from taking action in their investment portfolios. So I'll spend a little bit of time on each one of these barriers. First is from a regulatory and policy standpoint. We've heard a lot about regulatory and policy issues earlier, but the result of regulatory and policy issues for investors, and really what we need to help us build these risks and opportunities in the portfolios, is data. We need to be able to understand when we're looking at public companies and public securities, how a company is positioning around climate, how they're thinking about key financially material risks and opportunities, and we have to be able to stack that up against lots of other companies. So we need some standardization, some more data. So to give you a statistic here, in the S&P 500 in 2012, anyone have a guess on what percentage of S&P 500 companies had any form of climate-related disclosures? Any form, even one number, it's enough. Carbon emissions, yes.
Let's say about 3%. 2012.
2012, no, a little bit higher than that, just over 10%. But that's in 2012, that's 10 years ago. Any number, just one number, and about 10% of companies, right? Today, this year, anyone have a sense of what percentage we are in the S&P 500? What percentage of companies have some form of sustainability-related reporting? We're not allowed to answer so much.
Over 90%.
Yeah, 93%, exactly. Yeah, so from just over 10 to 93% in 10 years. You're seeing similar trends in Russell 1000 largest companies, right about 85%. Starts to fall off a little bit, I'll say, when you get into smaller companies. But that's due to regulatory and policy change. And actually, it's first and foremost due not even to regulation from governments, but from investor coalitions, shareholders, big institutional investors like CalPERS and CalSTRS. They're the ones that have initially been pushing public companies to disclose this data and to set out very clear targets. CalPERS and CalSTRS, for example, were two of their early leaders. Some of the coalitions that have been important. The IIGCC 2004 was formed in Australia and Europe, comprising institutional investors, comprising about $30 trillion. They were one of the first groups to really collectively push companies to start disclosing this and to start laying out their plans. We saw the United Nations Principles for Responsible Investment Forum. Today, about 4,500 members across the world that have committed broadly to this idea of environmental and social data disclosure from companies. We saw the Climate Action 100 Forum more recently. They've identified some of the largest carbon emitters using the power of institutional investor capital to affect change. We heard about TCFD earlier, and there's newer ones as well. There's something called the Net Zero Initiative that is asset managers that have committed themselves to ensuring that they're pressuring companies from a carbon perspective. So these have been really integral. They have really affected change. Now, certainly there's been regulation that has followed. The EU, we're all aware of the green taxonomy. We heard earlier the very good point that the most powerful tool is mandating this disclosure. So you have seen, when I look at European companies compared to the US, there was a lot more standardization and consistency there in the data. There's no question these have helped. Hong Kong, via the HFC, has come out with some regulation as well more recently. The SEC, I think we're all aware, has come out with some, still not approved, but suggested disclosures on scope 1, scope 2, scope 3 for companies across large, mid-cap, and small cap. Not approved yet, but all of these things together have created much more data for us as investors to be able to understand, to be able to sift through, to be able to stack up side by side. Hugely important. Now, all the data in the world is a nice thing, but what do you do with it? If it's garbage in, garbage out, you have a problem. And another big issue there is technology. So how can you use technology to be able to sift through all of this data that's suddenly available and figure out what's helpful to you as an investor and what's not. How do you combine it in a way that actually enables you to identify risks and opportunities? So there has been an enormous amount of technology. Certainly some of the larger, well-known ESG scoring firms, I would call them, firms like MSCI, Sustainalytics, ISS, all of us may be familiar with those firms. They've been helpful. Certainly they've run a lot of resourcing at this. They have been able to identify and be able to stack up companies side by side on similar financial and material risks. I do want to call out some of the more interesting alternative data sets that are starting to emerge. A couple of ones to keep your eyes on here. One is called Carbon Delta. That's an organization that has something they call climate value at risk. It's not really a bar analysis, I would say, but it's a nice name. But what they are doing is they're combining policy risks, transition risks, opportunities. They're putting it all together, and they're determining, in their view, the cost of that company by not transitioning. I really like that financial materiality link that they're doing. One more company for you. It's called 420 Climate Solutions. Actually, they were just purchased by Moody's. Really interesting. What they're doing is they have satellite imagery that looks at a company's entire footprint and supply chain around the world. And what they're seeking to do is looking at how companies are affected by rising seawater rise, more droughts, extreme heat, more catastrophes. With a company's footprint, including some of these large firms that have warehouses all over the world or need fresh water from all over the world, how will they be affected from that physical risk we heard about? So suddenly you have these tools to be able to sift through all of this wealth of data, combine it in an interesting way. Now, as investors, the third node is the most important. We're not just doing this to create an impact on the world. We're also doing this because as fiduciaries, we have to produce a strong risk-adjusted return. And there has been a wealth of mounting research, again, over the last 10 years, given all this data that's now available, to assess whether positioning towards companies that are strong on environmental risks and opportunities, how do they perform? Is it a detriment to your portfolio by doing this, or can it be helpful to your portfolio? So a couple of studies that I think have been very important to this space. One is from Chris Getze from down the street at the University of Penn and Gerard. And what they did is specifically is they looked at the effect of tilting your portfolio towards companies with strong environmental quality. And essentially that's defined as companies with an approach to how they're lowering their carbon emissions, how they approach toxic waste and disposal, how they're aligned with the temperature. And what they found was a consistent level over 3, 5, and 10-year periods of a generation of excess return versus the benchmark of those companies versus ones that are not. So a really important study that I think a lot of institutional investors read and saw, hey, you know what, I actually should, not only from an impact perspective, but should be considering climate risks and opportunities in my portfolio. And that will be aligned with my fiduciary duty. There's been other studies out there. One that I would suggest everyone reads if they haven't is a really important meta study that was just updated. It's by the Hamburg Institute. And this looked at 2,300 studies going back to 1972. Again, on the effect of tilting your portfolio towards companies strong on environmental and social, in this case, risks and opportunities. What they found was that 92% of the time, there was either a positive effect or a neutral effect from doing so. Of course, only 8% of those studies out of 2,300 studies, there was any give up of return. This is hugely, hugely important for the institutional investor community who is privy to a lot of fiduciary duty considerations and a lot of stakeholders to be able to do this, to take all of this data that's now out there, to use technology to put it together and to link it to financial and material risks and opportunities. So again, it is good news. This is a unique and really important time to be able to start to align portfolios with climate-related risks. Again, that's $70 trillion in capital markets value. So let's get into how you may start to actually build a climate-aware portfolio. So again, let's say you have all the data, you have the technology, you believe that it links to financial materiality. What are some of the risks and opportunities when you're analyzing individual companies in terms of how they're positioned around climate change? So the first is physical. I think that's very clear to everyone. We've heard a lot about it already around how your company can be affected by droughts, by seawater rise, by extreme heat. How will that affect the supply chain? How could that cause significant disruptions in the business? Reputational loss. This is something that particularly over the last few years has really come to the fore. There is increasingly a headline risk related to funding highly carbon intensive industries. I think it was Sean who said earlier around the cost of funding carbon, right? And how that's a price and reputation that a lot of firms are considering. You see, picketers outside buildings. You see headlines around companies that are the largest in terms of funding traditional energy. There is a reputational loss, and there is, again, from an investment standpoint, actually MSCI did some data on this where were these negative headline risks related to traditional energy, how that can affect investor sentiment and shareholder engagement as well. So that's an issue as well. Stranded assets, I think, are pretty clear. That's obviously this risk that as a company, you're going to have assets that are no longer able to function or no longer being viable because of some of the other risks you've seen on this page. Policy changes that render your power plants, in this case, unable to be run successfully. Technological shifts. Renewable energy, as we've heard, is starting to become faster, better, cheaper. Solar energy has come down by 90% in the last 15 years in terms of cost. Wind energy has come down by 70%. So there's a technology angle here. If you're a traditional oil and gas company, many of them are looking at how within their portfolio they can seek to align with how the industry is changing from a technology standpoint. That's really important. I happen to have a view that oil and gas companies will certainly be around in 30 years, but they might not be called oil and gas companies. They might be called energy conglomerates because they're seeing these technological shifts as well. And they're thinking as a business long-term over decades, how can they shift along with this transition? And finally, policy risks. Again, I won't linger on this because I think we've heard a lot about it, but certainly there's a risk to companies that are not positioned here of a stroke of pen risk. That there will be subsidies that are released, like we saw in the Inflation Reduction Act, $370 billion, largely of subsidies, also including a methane reduction program, which penalizes companies with high methane. There's also always rumors of carbon pricing and how that can essentially be a tax long term. We've thought about this. Companies are thinking about it too. And companies that aren't thinking about it, we do view as being at risk of this transition. So to close with one last page, and again, I'll linger on this because at this point we've talked about capital gap, we've talked about the barriers eroding and how this is feasible to be done in the first time in the last couple of years. And we talked about some of the risks and opportunities you might consider when you're looking at individual companies. How do you put it all together? So we see three clear approaches to building this holistic climate aware portfolio. So, you know, I'll start on the left-hand side, and this is this concept that I think most of us start with. Well, we'll just divest. And some investors have done this. We'll just exclude all traditional oil and gas companies. We'll exclude all fossil fuels. And certainly that's a tactic. You know, what we find is that selective divestment may be a better strategy, not only from a risk return perspective, but also from an impact perspective. So hear me out on this, and I'll cover this in the middle category here. But the selective divestment is essentially this idea of really looking at some of the largest carbon emitters in the world and deciphering within those, based on all this data we have, based on the commitments they've made, which ones are really, really poorly positioned towards the energy transition, which ones have not come out with any long-term plan around investments they're making in cleaner energy, which ones have not come out with any sort of targets, or very limited follow-through on those targets. Selective divestment can be a really powerful tool here from an emissions standpoint, and again, holding companies accountable that have not taken action. If you go to the right-hand side, this one again is, I think, what a lot of people think of when they hear climate aware portfolio. Sometimes they'll say, yeah, you know, in my role, I help investors, you know, align their portfolios with climate. And they say, oh, okay, so you're investing in renewable energy, green hydrogen, carbon capture, right? And the answer is yes, to an extent. That's part of an approach. Part of an approach, you absolutely should ensure that you're investing towards innovation, where the highest innovation is coming on the solution side. Now, some of those solutions are still in the private investment space. Today, I'm talking largely about publics, but I will note that you're starting to see some large Fortune 500 companies make pronounced investments in these areas. And that's another way to get exposure to this kind of solutions area of the coin. Now, the middle category is the most nuanced. And I think that the most up for debate, a lot of times, some institutional investors take umbrage with this idea of investing with some of these large bad actors, if you will. So there's kind of two different strategies within this middle lens. One is determining within, let's just talk about oil and gas, within the oil and gas sector, who are some of the leaders today in positioning their portfolios towards the clean energy future? Who are some of those companies that are making pronounced investments in transitioning their business? We've seen companies in the oil and gas realm make large, significant investments in green hydrogen, for example. We've seen others start to make investments in some of the newer nuclear-related technologies like fusion. Really interesting way to get exposure to some of these areas. Now, at the same time, another kind of key carrot and stick type approach here is engaging with bad actors. So using the power of institutional capital, like again, CalPERS, I'm lingering on them because they've been hugely important to the space, to pressure companies that are not following through on commitments they've made. And one of the big trends we're seeing this year actually is, I'm sure everyone in this room has seen all these companies come out with these 2050 net zero commitments. And that was nice, it sounded good. What we're seeing now is a lot of big shareholders come around and say, hey, 2050 is a long way off. A lot of you that are actually making the 2050 goals probably won't be in those seats by 2050. So show us some progress now. Show us what your 2030 goal is. Show us some annual reporting on how you're actually reducing your emissions to get there now. So bringing kind of the abstract, nice sounding commitment and bringing it into practicality, that's the big push we're seeing right now. Again, some of these big institutional investors, they've said, look, either set out these targets, show us annual reports on how you're changing your business, or we'll divest. So that's another strategy. You start in the middle, and if you see no action, you move to the left. That's kind of this carrot and stick idea. And when you're building this investment portfolio, using these three tools can be enormously helpful from a risk-adjusted return standpoint, right? As a portfolio manager, you're seeking to build a portfolio that is diversified and seeking to at least achieve market rate or better than the benchmark. And building these three different strategies into a portfolio versus just taking pure divestment, which modern portfolio theory suggests that you just passively exclude an entire sector, it's not optimal from a performance standpoint. The entire portfolio on the right, also pretty narrow investment universe, but using all three enables you to really widen out your investment universe while also delivering that impact. So I think I'm out of time, but again, questions afterward, happy to take them. But I hope what I've left you with is some optimism about how the public market capital investors can help, how really we're at this unique point in time where it is more feasible, more than it ever has been before, to build in climate-related investment opportunities and helping to close that $4.1 trillion capital gap. So thanks for your time.
Thanks, Bree.
Yep.
Yeah.
Yeah,
Thank you.
yeah, that's great.
Okay, so as Mark was saying, money's moving, and the question, or if we just take a look at this and just take a look at a snapshot, what we're looking at here is the global sustainable investing assets. So these are global assets, and you look at their latest report, their latest biannual report, and you'll see that assets worldwide in this sustainable space is at $35 trillion. There's a couple of things I'll point out here is that if you look at the growth, number one, between 2018, 2020, you'll see it's $5 trillion. So a huge dollar amount. But you're also looking at something that looks a little bit curious, is that if you look at Europe, you actually look at a decrease in numbers. And what many of the speakers have spoken about today is that Europe stepping up and setting up standards and classifications. And that is one of the reasons that that number is less, is that some of those investments have been classified in a different way. If we just look at the US alone, and this is US Foundation, they also do a biannual report. And what you're seeing is something very different. Here is that you're seeing that the growth here in the last 2 years has actually increased by $5 trillion in the US alone. So when you look at that, the question is, why is this growth in the US so prevalent? And number two is that everyone's talking about what has to happen is there has to be an investment to solve this climate change issue. So that's a lot of money that's moved hands over a short period of time. So shouldn't that help solve this net zero problem? And when you look at it and you're saying, yes, there's been a movement of dollars, the question that comes to mind is then why hasn't it been impactful or as impactful as it could or should be? in looking at the reasons why, there's really three key concerns, that we have. And these would be it. And it's basically, are the assets that are being invested into, whether mutual funds, ETFs, or just corporations, what we find is that there's definitional confusion. So what is a sustainable asset? And this is related to financial and non-financial items. And this also, if you look at categories of sustainable investing, there's this whole debate or confusion around values-based investing and ESG integration, which we'll talk a little bit about. The other thing is just investment product clarity. And with this, it's the alignment of investments with the values of investors. And this is where we're seeing greenwashing. And the last thing is there's a disclosure gap. And the disclosure gap is based on transparency. It's how do you measure this? How do you measure impact? In looking at this, and this touches upon something that Mark had mentioned, there's these services that are out there that are rating these companies, funds, holdings, and there's over 600 of them that are rating. And Mark had mentioned the three most prevalent are ISS, MSCI, and also Sustainalytics. So when you look at them and people say, well, if they come up with a good ESG score, that means that they're a good company. So I'll invest in those. But what you have to realize is that that ESG score is measuring on sustainability, on investable risk, and not in those ESG factors. So there's a disconnect between the two. And if I just give you an example, if we look at Coca-Cola, for example, Coca-Cola, if you look at MSCI, they're AAA rated. And so you look at that and say, oh, this is a good ESG type company. But if you look at it and you say, well, the last 4 years, they have been noted as the worst plastic polluter in the world during that period of time. So there's those types of disconnects that are there. The other thing that we're seeing is that there's so much popularity in the space that there was up until more recently, where you're seeing some negative articles that everyone wants to jump in, so they're making these false claims. So if you look at companies, whether it's Nestle, saying about their repackaging claims, or if you look at even British Petroleum, which is beyond petroleum, is the way that they relabel themselves. But when you look at that, they've done nothing about their carbon emissions problem, and they're actually dependent 96% on oil and gas. And then you could go to Volkswagen, which everyone looks at as one that occurred in 2015. But this is also permeated through the financial markets. So if I look at Deutsche Bank, so we're looking at May 31st of this year, they were found that when regulators rated their offices, found that they're making claims that were not true, and they were had greenwashing claims. The CEO actually had resigned. And if you look at BNY Mellon, you're looking at not one year, but over a 3-year period of time. They said that they were doing ESG analysis on their products, their mutual funds and ETFs, and they weren't with that. So I guess the thing that Mark had brought up again was about the SEC. So where are they at with this whole role? And because we need some type of regulation. And as Mark said, they've come up with some proposals. The one that you personally you read about is the Commissioner Hester Pierce. And her view on this is that unless we have definitions, unless we have classifications, with this, how are we to measure this? And if we're dependent on the ESG rating systems, doesn't that mean that any company that's rated well from an ESG standpoint, there's more dollars that flow into those products? And let's just say if it's an index and those products end up in an index, which means more dollars flow to these underlying corporations. So the proposals that they come up with is around the mutual fund side, the name rule, which says that 80% of holdings have to align with the name of the fund. And they're trying to do this with ESG around green funds or sustainable funds. And they're also trying to put, if you say we're an ESG fund, or if you say that's you're marketing yourselves as such, you're going to have to show how you do your research in that particular area. So these are some recommendations that we have. It's just adoption of the standardized definitions, and these are the 5 categories along with the proxy voting. And you recognize, some of these, but it'll help differentiate one from a fund from the other. The other thing is that create a classification system so you can start measuring these results. And these are a few examples of ESG integration is the largest of these categories, but even within these categories, there are differences between those. So it's difficult to measure one fund or product against another. And the last recommendation we have is to close this disclosure gap. So to make things easier to understand, to make things in a reportable standpoint that you'll be able to differentiate and match the value, your values or the investor values with the product. So that's the conclusion of my piece. Happy to address any questions at the end.
I think our last speaker for this session came from Washington, D.C. I want to thank him, Klaus. Thank you for coming down early. He's from the World Bank, and of course, his views do not represent the views of the World Bank. Right? Good. Full disclosure.
Yes, thank you, George. So I will, of course, speak from the perspective of a multilateral development bank, that is a World Bank. And here, from the perspective of a provider of public climate financing to developing countries. And if you look at the overall picture, you see that available international public climate financing is really drafted by the needs. The blue dot is the climate-related development financing that is currently available globally in an order of magnitude of $55 billion. And the small yellow dot is the dedicated public climate financing, that is the money that is sitting in specialized climate funds like the Green Climate Fund or the Climate Investment Funds or the Global Environmental Facility. These numbers are annual loan commitments, and indeed international public climate financing consists primarily in concessional lending, concessional loans, and to a smaller degree in grants. But what you see already from these slides here is that this huge difference by orders of magnitude between needs and available public financing need to be closed primarily by private financing in developing countries. So these $4 trillion annual needs
in developing countries in terms of cross investments need to come primarily from private financing, to a smaller degree as well from domestic public funding in developing countries. Now, a few words on this matrix cross investments, because it does not mean that all this money is fresh money and needs to come from somewhere. Most of it will come from simply shifting what is currently invested in brown assets into green assets. But most experts agree that the green economy is also a more capital intensive one than the brown economy. So there is also an incremental need for more lending, for investment financing. In principle, shifting resources should be able to do the trick, because most people would agree that overall a green economy can be more cost efficient than a brown economy, because the higher capital costs are compensated by fuel savings, even if you are not looking into monetizing the externalities consisting in non-climate externalities, for example, health issues related to air pollution, and of course the climate externalities. So the art, if not to say the science of public spending, is to make these shifts of private finance flows happen, and not to try to close the gaps through public lending. And a lot can be achieved, of course, in internalizing the external costs, and that means also in monetizing them and in creating additional fiscal space, for example, in taxing carbon and in removing fossil fuel subsidies. Transition costs is certainly a space where public money, mainly public money, is called in, and we have heard that in several presentations already. These are basically compensation payments that you have to make to negatively affected households, workers, and industry in transitioning to a green economy. So how to do that, how to use this very limited public climate financing in the most effective and the most efficient way to mobilize private resources? Well, we analyzed that in a recent report on transformative climate finance, but the bottom line is you basically have 4 buckets of key activities. One is, of course, the project financing itself, and the financial engineering of de-risking of public-private co-financing, of providing guarantees, for example, of providing political insurance products to maximize private finance flows, and to use concessional lending where the private sector cannot come in, for example, or difficult to come in, for example, in the transition cost space. But then the other big bucket are policies. I mentioned already fiscal policies such as carbon pricing, and I want to zoom in particular in the next slide on the space of financial sector reform policies. The third bucket are carbon markets, which can be a very powerful instrument in transferring resources from rich to poorer countries for climate mitigation purposes. And climate intelligence and data, I think the previous speakers have already alluded to the importance of that particular bucket. So let me zoom in the remaining time on financial sector reform and carbon markets. One type of intervention into the financial sector through financial regulation is to reflect climate risk in capital requirements for commercial lending. And that can be done through a green supporting factor or a brown penalizing factor, or a combination of both. The basic idea always is that the regulator reflecting this climate risk in capital requirements for commercial banks with that policy, increase the relative price of brown lending relative to green lending, and through that, relative cost of capital. So we analyze these impact channels. I will not go through this charts here. We modelize them, we model them, and we use them to estimate the mitigation impact in the real economy that such a change in the relative cost of capital can have, and it is quite substantial. And this is a different type of greenhouse gas accounting that you need to use for such a sectoral approach, obviously, from doing it on a project by project level. And there's a huge knowledge gap in that space, because currently we have hundreds of methodologies available for individual investment projects, but almost none for more sectoral and policy type of interventions. This is something that is still in its infancy, as well as the discussion on greening monetary policies. And of course, this is not about using financial regulation in replacing direct climate policy like carbon pricing, but in reflecting risk in a correct way into financial regulation and into monetary policy, and that can have huge mitigation impact in the real economy beyond what is currently being done in a project by project approach. So that is an example for policy. Now we are moving to carbon markets, and carbon markets are particularly relevant for channeling resources between countries, climate resources, and particular to developing countries. The climate crisis will be resolved or not resolved in emerging markets, which are already standing for the bulk of the greenhouse gas emissions. Even if Europe and the US completely decarbonize, we would have no chance in stopping global warming without approaching the emerging markets. Now, we heard that we have here an issue of resource constraints in these poorer economies, and therefore there is a need and an interest in making sure that in an effective and in an efficient way, resources can be provided from the richer countries to these poorer economies. And one way of doing that, besides development assistance and besides international climate financing, so besides using public budgets in developed countries, is in establishing an international carbon market. So this is modeling here, this work that you are seeing, we did back in 2016 at the World Bank in looking at the 2030 targets at that time expressed in the INDCs of the Paris Agreement parties. And you see, for example, if you pick a country like India, in this modeling under the assumptions that were made, they could expect an inflow of payments in an order of magnitude of $50 billion, whereas a country like China would purchase emission reductions in an order of magnitude about the same. So that can substantially complement the international resource flows that we are already seeing happening through public financing. A very recent study done at the University of Maryland came up with an analysis of the cost savings of for the global economy in achieving targets, 2030 NDC targets in a collaborative way, which is about $300 billion per year, and reinvesting this money into additional mitigation would allow basically to double the ambition that sits currently in the first NDC's nationally determined contribution of the Paris Agreement. So the numbers here are not, again, I'm always insisting on the point of understanding the matrix that are used. This is not finance, this stands for cost differentials. But if you are recycling the cost savings, you can imagine what a lever this can be for public financing and for private financing. So it's a very important area to look at. However, these carbon markets are difficult. We know that from the experience with the Kyoto Protocol. We have all kinds of environmental integrity issues. We have short-termism in these markets. Are they aligned with net zero in 2050? We have very complex issues under the Paris Agreement, because for the first time, everybody has a target now. So countries ask the question, can they really sell mitigation outcomes, or do they risk to miss their target? In a liquid market, that wouldn't be a problem, but the market is not liquid at all. Basically, it doesn't yet exist. And there are certain features of the market regulation under UNFCCC that makes it very difficult to build up liquidity. For example, there is a complete lack of intertemporal flexibility between the NDC periods. Nobody knows how to price currently under these circumstances carbon assets, because you need to somewhat now not only look into the cost of the mitigation outcomes generated by certain activities, but also in the opportunity cost of selling, because what you are selling you cannot use against your own target. So these issues together are major stumbling blocks for building up these markets and for participating in them. And here again, public finance can play a key role beyond this traditional role it has to provide concessional loans and grants in piloting these markets and in doing things like de-risking through providing floor prices and guarantees for these transactions. And I stop here and give it back to you.
Thank you very much. These are fascinating topics when we talk about climate change and capital required to impact. Financing, of course, is on the other end. We hear different numbers, huge numbers here. The question is, every time where there is an investment and which is financed by private capital, expected returns are one of the top issues on the agenda. So what do you know about expected returns of institutional portfolios that have geared their investments in climate friendly kind of impact investments? Is there any evidence that doing good also means that you're doing well in terms of returns? Anybody who wants to take it?
Maybe I'll start. Again, I will reference a really good piece. If you look up Chris Getzi from University of Pennsylvania, this just came out last year, which looked at this exact topic. And actually the way that he did it was not just looking at, pools of equities, he looked at institutional investor experience. So this is the composite, if you will.
Risk-adjusted
returns in terms of how investors that have taken on this approach have done so. And I think what's interesting in his research and others, George Seraphim is another name to look at from Harvard Business School, who's done a lot of research here. It's really interesting is they look at investors that are just purely divested. And I think there's a school of thought out there that just a pure divestment strategy would not be an optimal performance approach, which is fair. Again, modern portfolio theory, totally fair. And certainly over this year with Russia, Ukraine, emergence of energy independence, the investment strategy would not have been a good strategy over this short-term period. But my point is, even with just pure divestment strategies over long periods of time, you have seen very little effect on annualized returns from doing so. I just saw a study that was 45 years of data, and it was within 20 basis points on an annualized basis of the difference. But what I would impart on everyone and what we've seen in terms of institutional investors that have had the most success from a performance standpoint is this approach that combines selected divestment with investing in traditional energy companies that are transitioning towards the future. That's the evidence has been that's a stronger investment approach. We happen to think it's a strong impact approach as well. And it is an approach that has shown to hold up during periods like this year, again, where energy independence has emerged and transition fuels are a part of that. So,
thank you.
Yeah, and I would agree with Mark's assessment. I think the thing that's a little bit tricky is that you have people kind of screaming from the rooftops when their performance is good, and you find out that okay, they eliminated oil and gas, and so when you eliminate a sector and the sector does terribly, yeah, you did good, you overweighted technology. When that flip-flops and, you know, over the past year, you had the oil and gas industry outperforming, they've become very quiet, in their claim for performance.
Very good. I want to open it up. Any questions? Yes.
I wonder if there's any information about the number of meteorologists that are serving on the board of the Fortune 1000.
I can comment on that.
Yeah.
That's a question after my heart. Thank you. I don't have an exact answer. What I can tell you is that in my career as trained natural resource scientist and also the CFO, how many people have I met who are trained natural resource scientists working in Wall Street? Well, one. Chris, who's at BlackRock, he's a PhD. One, maybe two. I mean, it's just not. In other words, we don't have that educational supply chain people from coming from Drexel who are trained in natural resource science or in meteorology or in climate science going to capital markets. They just don't know that career path exists. There's a complete barrier on communication. People don't even know how to talk to each other. So languages are so different, and socially they're very different. They're just very different people. I was at the Ecological Society of America annual conference this year. It's all ecologists, and I did informal A/B testing. So one day I wore a suit, next day I wore flip flops. And let me tell you, when I wore the suit to the ecologist conference, they were not happy. They were wearing flip flops and the t-shirts with all the other professors. Like, yeah, you're like me. So there is also a tribal sort of sense, but people just don't know each other. So the answer is close to zero, if not zero. But that's where the opportunity lays.
I know one, that's why I asked the question. I just wondered if there were more. And it's a company called SIG, Susquehanna International. And I asked them if they had an economist on their staff, and they said no, they had a meteorologist.
Which is helpful, I guess, as opposed to getting none. Any other questions that the panel can address? One of the things is that there are so many initiatives on sustainable climate change initiatives. I think the classification that you presented, the classification of various investments and investment portfolios, this classification, is there evidence that has helped us navigate the space and make the appropriate investments, portfolio investments, or is it just a new thing that needs to be tested, so to speak, in the investment world?
Yeah, I would say that if you look at Europe, they already have a classification system. If you look at the US, they don't. So it's almost like the Wild West. So we did a study a couple of years ago, and we looked at these numbers, and just like now, you say $1 in every $3 are invested sustainably, and it's just I see the number, but it doesn't feel right. So we did a study that looked at mutual funds and ETFs in the United States, and found out that 86% of the growth actually came from rebranding, changing the names of funds, or changing the perspectives of funds, rather than new dollars that were flowing into the space. So I think, how do you measure something unless you can identify how does the SEC regulate, unless they can define what it is.
So the regulation is going to come on behalf of the state or on stakeholders, institutional investors. Who wants to see this regulation?
The investment industry doesn't, because they could operate any way they want right now. It's got to come from either the industry saying that we need to regulate ourselves, and we'll come up with guidelines, and we'll
Self-regulation,
or the SEC to say the same. Or might have.
I mean, I think asset owners absolutely want this standardization. I think it's really important, actually. It's going to be a little bit of a tipping point in our view when this regulation does come along. I mean, the SEC has proposed this taxonomy, if you will. a consistent naming approach of an ESG integration versus ESG focused funds versus impact. And really importantly, what they've said is if you are just integrating these factors throughout your investment process, you're not using specific streams, and then you can't have ESG or sustainable or impact in the name of your fund. It's actually really important for the asset owner community, for the retail community, and even for the investment industry and asset management community. Because look, there's greenwashing out there, but and look, I'm sure some of it's intentional, but I don't think most of it is. I think most of it's unintentional. There's just a lack of standardization, and there's a lack of of information out there for how to label these consistently. So from looking at studies, one of the CFA Institute, the biggest challenge that has held back many from allocating here is confusion over terminology. And I think this is a really important standardization that we see coming here.
Let me,
Thank you.
that's a great point. I was gonna have a slide, but I didn't do it, which is the definition of sustainability, kind of risk and ESG. And it's just really important to know that when you use those words are very, very distinct, please. Sustainability, so if you have a cheat sheet, you're taking notes, sustainability means sustainable development goals. There's 17 goals, 232 metrics. That's the lens, that's an economy-wide lens. It's very broad. Climate risk includes a couple of the sustainability development goals, but most of it does not. And there are cases where climate risks issues are not addressed in sustainable development goals. There's a little bit of an overlap. ESG is a very thin silo. Environmental social governance is a very thin silo. Think of like the 2,000 metrics that are in Bloomberg has. Think of a ratio. Some like number of employees divided by sales, or number of employees emissions, something like that. The environmental social governance is a very specific, very small silo. So whenever you're using these phrases, make sure you have in back of your mind, you're thinking, oh, what data set am I referring to? And then use the right word. And that's part of why this confusion device. We don't have in our common language, consistent framing. So it's like me saying, I'm saying baseball, and you're saying football. I'm thinking, oh, they're different, So.
Yeah, Klaus?
Yeah, I can only confirm that. I mean, what we are seeing in this developing countries is the first task is always with the financial sector regulators, with the central banks taxonomy. So the European Union's taxonomy really provided a prototype and a model many countries are looking at. And it is so crucial not only for voluntary action, but it's also crucial for directing public action and public incentive programs or even public regulation. Then the methodologies are absolutely crucial as well. Greenhouse gas accounting methodologies a lot exist already. And standards exist. There are huge gaps. I alluded to some of those gaps. The climate risk assessment was a time being a big research topic. Physical risk before we have a better sense of, but transition risk is really difficult to quantify, and requires also a somewhat different type of approach, because it cannot be backward looking like most risk assessments try. It needs to come up with this type of scenario analysis. So a lot of central banks are struggling with that, and they see that there's a huge gap, and whole departments are created in central banks in the attempt to closing this gap, in getting a better understanding and handle of climate risk. That's also a very big research topic where a lot of knowledge gaps.
Thank you very much. I think we covered a lot of things in the second session that involve climate change and capital markets. Thank you very much.